Welcome to JLL's third quarter industrial property market wrap for 2016. The Australian economy continued to expand at a solid pace in the second quarter of the year, mostly due to net exports contribution to GDP. More recent data indicates an environment of easing population growth, slowing employment and income growth, and moderating retail turnover growth. On balance, these factors are likely to be less supportive of occupied demand for space in the industrial sector in the near term. Meanwhile, investment demand remains very strong, though there has been a dearth of stock formally offered to the market in recent months. Despite this, transaction volume for the year to date is in line with the same period last year, having been supported by a few very large off-market transactions recently. One reason for lower transaction volumes is that REITs have been less active in disposing of industrial property due to ongoing earnings pressures and also the challenge of replacing income if occupied properties are sold. Most REITs' gearing levels remain around the lower end of their target range, suggesting options to fully deploy available capacity have been limited. One area that market participants continue to deploy capital into is development. Investors are acquiring sites ready for development in the near term, seeking to grow their asset base and improve the quality of their portfolio while generating development margin or yield premium relative to equivalent market yields for existing stabilised properties. The development market is highly active and competitive as a result of this. The key market highlights in the third quarter of 2016 include occupied demand in Sydney remains very strong, with more than 700,000 square metres of gross take-up in the year to date already, which is well above the 10-year average. New supply in Sydney is picking up as a result. It will be the highest since 2012, and the pipeline for 2017 is likely to be slightly higher again. The majority of development is pre-committed, but some speculative construction is taking place to capture immediate demand requirements. New supply in Melbourne could exceed 600,000 square metres for the first time since 2008, continuing the trend of above average supply since 2014. While construction levels are declining in Brisbane, Perth and Adelaide, the pipeline in each of these markets in 2017 is very thin. Prime grade rents were generally flat to falling this quarter, with Perth leading the declines, with prime face rents down 4.9% in the south and 3.6% in the north precincts. Prime rents also decreased somewhat in Brisbane by less than 1%, and rents were broadly flat in Melbourne and Adelaide. In Sydney, rents increased in the north, south and outer northwest precincts. Tenant incentives have increased for pre-lease deals in Sydney's outer west and in Brisbane, while incentives in Melbourne, Adelaide and Perth reportedly remain steady but elevated. Yields tightened a little further in Sydney and Brisbane last quarter, in line with transaction evidence, with buyers active across a broad spectrum of asset risk profiles. So make sure you visit JLL's Insight, the online hub for all things industrial and logistics, including research, market data, sales and leasing opportunities, and the contacts of our senior team. Thank you.